All right. Welcome back to Accounting 101. Here we go. We just went over how the income statement and the balance sheet work together. Lovely retained earnings. So by the way, for any financial analysts out there, if your balance sheet doesn't balance, consider checking your income statement. This is an argument I've had with several people because they're like, oh, it's on the income statement. It's a revenue or an expense. And I'm like, usually when there's a problem, it starts in one of those two and it trickles down to the equity. That's why it's not balancing. So anyway, pro tip. I have not been wrong about it yet. So if we take a little sneaky peek at Business ABC, we're just going to call this a nonprofit because we're going to think of this revenue as a donation, okay? They got a $10,000 revenue donation. We're going to say it's unrestricted, but it could be restricted or unrestricted. Doesn't really matter. They had $9,000 in operating expenses alone. So they weren't purchasing assets or anything, just operating expenses. 10,000 minus 9,000 leaves them with 1,000 net income. And then what we can do is follow the nice little trail that I had for net income. And we see that that goes right into equity. But wait a minute, because we are reporting on the balance sheet $1,000 in equity from the net income up here on the income statement, we now need to report $1,000 in assets. And we're going to say it's cash. So they just had leftover cash. They made it a part of their equity. It's a nonprofit. So we're going to make it a net asset. And then they're going to have $1,000 of cash sitting on their balance sheet. And because this company doesn't have any liabilities, they don't have any accounts payable, they don't owe banks any money, they didn't pull out any loans, we're keeping this simple $0 in liabilities. So you can see here, $10,000 of revenue translates to $1,000 of net income, which translates to $1,000 in assets and $1,000 of equity. One mistake I see new people making is that they will say $10,000 in revenue equals $10,000 in assets, $10,000 in equity. Not correct. You have expenses. And then here, let's take a look at this other nonprofit, Business XYZ. They had $10,000 in revenue and $9,000 of expenses as well. But with their revenue, it was a strict restricted donation. Doesn't really matter. It could be unrestricted too. But they had operating expenses and they bought a computer for $1,000. Okay. So that's actually going to be, that computer is going to be an asset. So they made 10, spent 9. They still have $1,000 of net income. So when we come down to the balance sheet here at the bottom, $1,000 is their cash asset. $1,000 is their fixed asset. That's their computer. They didn't borrow any money. So they have $0 in liabilities and they have $2,000 in equity because again, balance sheet has to balance. So these $2,000 summed up here equal this $2,000 down here. So we can see this asset came down to be an asset here as the fixed asset in the computers. The net income came down to be a cash asset here, but it also came down into equity where it was reported as the cash in the computer. I'm keeping this example very simple and not getting into depreciation. But again, 10,000 in revenue does not equal 10,000 in assets, 10,000 in liabilities, 10,000 in equity. That's a common mistake I see. Okay, it's not super common, but I have seen it. Now you know the very basics of how your financial statements work.